I'm Stacey Marie Ishmael, managing editor of crypto for Bloomberg News. And this is Bloomberg Crypto, a daily Bloomberg iHeart podcast. It's Tuesday, August 2nd. One of the most interesting conversations in crypto right now is all about definitions. And what I mean by that is crypto a security? What's a security? And what does that mean in practice? We are once again very fortunate to be joined by Bloomberg Opinion columnist Matt Levine.
I think that the idea of having a safety and soundness regulator for a crypto exchange, this feels many years away.
Who is, or at least was, a practicing lawyer and someone who has written really extensively about securities, securities law, insider trading, all things that are very much topical in crypto right now. Matt also interviewed Sam Bankman-Fried at the recent Bloomberg Crypto Summit in New York, and SBF, as he's known, made some very interesting remarks about regulation, clarity, collateral, predictability.
Profitability was sort of a dirty word for a number of years, and it is returned to investor parlance.
Over the course of this podcast, we'll play you some highlights from Matt's conversation with Sam Bankman-Fried. Matt, welcome back to the podcast.
Thanks for having me.
I want to talk about something right now that does feel novel in the crypto context, which is people seem to actually be getting regulated at the moment.
Do they? I would have said
let's talk about it.
There are rumors being reported about people considering regulating them one day. I don't think people are getting regulated per se.
Well, they're getting arrested.
Yes, sure. They're getting arrested for insider trading.
Coinbase is facing a U.S. investigation on cryptocurrency listings.
Is this connected to the insider trading investigation that was brought against a former Coinbase manager?
Did any employees inappropriately trade ahead of the announcement?
Here in Coinbase, by the way, says it did nothing wrong. But of course, we have three sources telling Bloomberg.
There was an ex-employee of Coinbase who got arrested on allegations that he was insider trading 9 crypto tokens, knowing that they would be listed and kind of that their prices would go up once they got listed on Coinbase. The weird thing is, for the SEC to bring this action against this employee, they would have to have defined those crypto tokens as securities for the purposes of their jurisdiction. And that seems to be the thing that has absolutely freaked out a whole bunch of crypto lawyers and CEOs this week.
Crypto lawyers are freaking out. I don't understand crypto lawyers, man. I just don't understand it. This is a years-long thing. To me, the SEC, I think, has always thought that almost all crypto is securities. I think they think that Bitcoin is not a security. I think they have accepted that Ethereum is not a security for sort of historical we forgot about it reasons. And I think if you came to them today with Ethereum, they'd be like, that's a security.
Right.
But I think almost everything else I think is a security. And I think that you look at some of the projects in the Coinbase case, these are companies that are raising money by offering a share of their future profits in order to build a business. It's just so clear that they're equity securities. It's so clear. And these crypto and and I don't understand the sort of legal analysis of crypto, because it is the case that big law firms are giving big venture capitalists and Coinbase, which is a public company, get the advice that lots of these companies that are raising money by selling equity securities are not selling securities, and so you can list them as commodity tokens on your exchange. And if you're a venture capitalist, you can buy them and then immediately blow them out to retail without being an underwriter of a security. And I think if you talk to anyone at the SEC, they're like, that's nuts, man. That's nuts. And they've thought that forever, and they've said it publicly forever. I think there's nuance to that. And there have been SEC speeches where there's a path to a utility token that is not a security. But I think in general, the sort of posture of the Trump SEC, the Jay Clayton SEC, was all these things are securities, and they brought a lot of enforcement actions against. They used to be called ICOs, right? Initial coin offerings. Right? It was just the term that fell out of favor because they kept getting enforcement actions for them. And the Gary Gensler SEC, I think, Gary Gensler has said publicly all of these things are securities, and the Clayton SEC was right about all of it. But they haven't brought a lot of enforcement cases, and so there's been this sort of acceptance that you can kind of do this stuff where you are issuing governance tokens and I'm exaggerating a little bit as I describe this. Clearly a lawyer has touched this, right? There's an argument that these things are not equity securities, right? The argument is these things are governance tokens, they're utility tokens, they are usable in some app, and they don't carry equity-like rights to the profits of that protocol.
We've just talked a lot about securities and the SEC and tokens. If you, other than telling people read your newsletter in which you write about this constantly, how would you define securities for our listeners?
So securities, it's a complicated question. So like the main thing is like stocks and bonds, right? Like a share of stock is a security, a bond is a security. And then the SEC has this thing called the Howey test, which comes from a Supreme Court decision, which is for a thing called an investment contract, which is another thing that's part of the statutory definition of a security. An investment contract is a security, and what makes something an investment contract is like there's a multi-part test, but it's like basically an investment of money with the expectation of profit from the activities of someone else, right? So if you like give money to a person who manages a company and she does some stuff with your money, and then you expect a return of your money, with a profit from like her activities, that's a share of stock kind of. But like if you don't call it a share of stock and it has different bells and whistles, then it's still an investment contract. And I think if you look at the crypto world, I think most people would say Bitcoin is very clearly not a security because Bitcoin, people buy it because they expect profit. But there's not like there's no
agent acting on behalf of Bitcoin
to like make a profit, right? It's just purely, it's like gold where like you can buy gold thinking the price of gold will go up, but it's not doing anything, right? You're just expecting the market to go up. But there are these nuances where like buying something because you think other people will buy it doesn't make it a security. Buying something because you think it'll be useful on a protocol doesn't make it a security. Buying something because you think like someone will build a useful business that will make it profitable makes it, more or less a security. And tokens kind of have all those things intertwined.
So, Matt, we're going to talk about Celsius. And before we start talking about Celsius, I want to just contextualize this with SBF sort of riffing on stage about the test that he had for whether he would or would not consider bailing out a crypto company or a crypto lender like a Celsius. Here's that.
Right. The first test is not even which is bigger. The first test is, do I walk away from that first call feeling moderately confident that I know what the numbers are? Whether or not they're good, do I even know them? Right. And like that was like sort of like the test for us to like consider doing like just some emergency thing while we figure out other things. One of the criteria was that we know what the numbers are, whether or not they're good. And some failed that test of like, not just the numbers were bad, but like we literally came away confused.
We've talked about one domain in which people are clamoring for a certain type of SEC clarity, but there's another domain in which people are also clamoring for any type of SEC clarity, and that is situations like what's happening with the Celsiuses, the 3 Arrows Capital, where you once again have a bunch of people who arguably should have been smarter about their risk management, etc. And, in an interview that you had with Sam Bankman-Fried, he was like, maybe a regulator should have asked, is there any collateral backing this? Is there like anything substantive to this?
Right. I think one thing that regulation would really want to do is like ask, is there collateral? Right. Like that seems like a really important perspective that like there should have been some amount of oversight or transparency or like, enforce good risk management on. But there just wasn't. And again, from an outward facing perspective, no one has any idea whether or not you actually got that collateral.
These crypto lending protocols, I think, were very highly leveraged and investing in weird stuff. And people may not have realized how leveraged they were or how much weird stuff they had or how concentrated it was or how unsecured it was. As Sam Bankman-Fried said, people sort of assumed there was collateral and a lot of these things were making unsecured loans. So one thing is you could have better disclosure. And one way to get better disclosure is to register things as securities. And you look at Celsius, the product that Celsius was selling was very similar to the product that BlockFi was trying to sell.
That they got fined $100 million for.
That they got fined $100 million for. And that the SEC said, this product, this crypto lending product, is a security, and so you have to register it. And by the way, Coinbase tried to do a similar thing. They got shut down before they could even do it. So is crypto lending a security? Well, the SEC certainly thinks it is. And the fact that Celsius was doing it without registering it, one, suggests that the people involved in Celsius could be liable for deep pockets that floated around Celsius, people who promoted Celsius, people who bought Celsius, tokens and sold them or whatever, or the people involved in Celsius could be liable for, unregistered sales of securities where they'd have to get the money back. I don't know how valuable that is because the money's gone. It's not like there's some other pocket of money that has the Celsius money. But so that's one thing. Another thing is should they have registered that? If they had registered that, then people could have looked at their financial statements and said, oh, this is super levered, right? I don't want to put too much emphasis on that because Voyager is a public company
Yep.
that does have financial statements.
Listed in Canada and
listed
the
in
US.
Canada. It's based in the US, but listed in Canada.
Yep.
And like you can go read the financial statements and you can be like, oh wow, this is 25-1 levered and like investing in crypto. And people bought it anyway, right? So it's not like
Transparency is not the end all.
yeah, I mean, think about like how people invest in crypto. And people think about how people invest in stocks, and like ask how many people are going to read a balance sheet. Like there's a assumption in the stock market that like super dangerous over-levered companies like won't attract a lot of institutional capital, and so like the price will be low and retail investors won't buy it. And I think that's less true in crypto, and it's like less true in the stock market than people thought it was, because like you have events like GameStop where the sort of institutional conventional wisdom doesn't dissuade people from taking a flyer on the stock.
Coming up, more on Coinbase, securities, and Sam Bankman-Fried's crypto strategy with Bloomberg Opinion columnist Matt Levine.
The other thing I'd say about Celsius and like the blow up of crypto lenders is like when Sam Bankman-Fried says, maybe a regulator should have asked if they had collateral. That's not really an issue for the SEC. That is an intuition around banking. These crypto shadow banks are banks. One big symptom of the crypto winter is like there's been a blow up of a number of platforms that I would sort of loosely call crypto shadow banks, where they're sort of taking in short-term demand money from customers and lending it in weird, opaque ways. And you have touched in some form probably all of those. You've been a lender, a borrower, a rescuer. So like the natural segue is like how much of the rescuing activity is about that very long-run view of like it is healthier for the crypto ecosystem that you are levered to for depositors not to be constantly blown up.
That's a real part of it. And maybe to make this like more concrete, the explicit sort of like working principle we had in a number of these was like, it's okay to do a deal that is moderately bad in bailing out a place. Like the bar was not, this is a good return on investment. The bar is like, this is not that bad of a return on investment, or like we are incinerating a relatively small-ish amount of money in doing this.
Actual banks, get collateral for their loans and like, don't concentrate all their loan portfolio.
Have to pass stress tests.
Yeah, like they have a lot of stuff that regulators impose on them that are not about, the SEC is essentially a disclosure regulator, right? And like banking regulation is not essentially about disclosure. It's essentially about safety and soundness. And there is a system of regulation based on safety and soundness for banks. And one sort of stress point in the traditional financial industry is about like what sorts of shadow banks should get swept up into what sort of like quasi-banking type regulation, where you have like, money market funds are just like, oh, they're SEC regulated, they just do whatever they want. And then like people are like, no, that's bad because they're kind of a bank. And so like it's driven by the SEC. There's some, amount of like capital and safety and soundness regulation that effectively applies to money market funds because they're bank-like. And then in crypto banks, it's like, we'll see what we can get away with, And like you could say, well, they should have to register securities and disclose their financials, but like you look at Voyager, like that doesn't help. I think that like the idea of like having a safety and soundness regulator for like a crypto exchange, it feels many years away, right? And very like antithetical to like the philosophy of
the
crypto.
whole thing.
Right. Like the Fed is going to set up a new regulator who will tell crypto exchanges what they can invest in. It just doesn't seem like that's going to happen, but it's also one way to prevent exchanges from losing all their customers' money. I think that like a thing that happens here is that people, it's a bull market. It was a bull market. It was a bull market for crypto. People are used to like things working the way they're supposed to work. People got like coddled by like financial exchanges and banks, like just kind of working. And so when they put their money into Celsius, they're like, well, that's my money. I'll get that back even if, they sort of expect things to work in the nice way. And then like they work in a terrible way. And maybe like in the future, people will ask better questions.
I love your optimism.
I'm not that optimistic. I'm saying this for completeness. But like, I would separate like, will people like learn substantive lessons from like, will people be less enthusiastic about putting their money into crypto schemes when the crypto schemes go down, right? Like, I don't know.
We shall see. I've been fascinated. We had an interview with the founders of 3 Arrows Capital in which they kind of told us on the record that their biggest mistake was expecting that markets would continue to rise and that credit would continue to be available henceforth. And sure, but it does strike me, and this is also something that SBF said.
When you look at the companies in crypto and frankly across the space, I think profitability was sort of a dirty word for a number of years, and it is returned to investor parlance, right? Like last year, if you saw a typical funding round from VCs, like was that valuation related to the profit of the company? Probably not. Like revenue was sort of like there's sort of, without saying so explicitly, everyone just subtly slipped from like, you know, EBITDA or profit or something to just purely revenue as like the driver of value, and like no thought towards like how profit would eventually catch up to that. And I think that there's been a substantial re-rating towards looking for at least likely or at least plausible pathways towards profitability being a core component of an investment thesis in a company, which feels a little strange to say, but I think was something that was kind of missing.
Do you think any of this is going to change for institutional lenders and investors and players at all? Or are we just going to be like having another conversation in 5 years being like, remember when?
I don't know. I don't know what, I mean, so what does institutional mean? I mean, like one thing it means is like the most cynical possible view is like you're putting money into protocols that you can blow out to retail, right? Where like as institutional is doing an arbitrage between, you know,
pots of money.
Yeah. And I think that, you know, one would hope a retail pullback sort of eliminates that. And then you have institutional investors who are thinking, you know, about investing in building some sort of long-term viable business.
We'll see.
It's a different skill set, right? I mean,
the skill set disconnect, it is real.
Like, what are you doing as an institutional player in crypto? Like, one thing you could be doing is you're a tech venture capitalist where you're like picking teams and businesses that will build long-term viable, valuable products, right? Another thing you could be doing is like you're a hedge fund or like electronic arbitrage firm. Mm-hmm. And there you're like, there are a lot of gamblers. I can look at like patterns in that gambling and try to, you know, anticipate market moves and make money from it. And like, that's a viable institutional product. But like, there needs to be some audience that you're interacting with, right?
Right.
Like,
who's on the other side of those trades?
Because if it's just like a bunch of arbitrage hedge funds, then like, you know, that business gets a lot more cutthroat. And also like that, if it's just those people, it goes away, right? Because like, there's
you literally arbit out of existence.
Like that business exists in the stock market, right? But the stock market is like doing something, right? It's like funding businesses. And so like you need to have that underlying real economic activity in order to run an arbitrage business against it.
Indeed. Well, thank you. Terrific.
Thank you.
You can find more of Matt Levine's work on the Bloomberg terminal, on Bloomberg.com, or on Twitter. He's Matt_Levine. That's Levine. On the next episode of Bloomberg Crypto, despite being one of the leading cryptocurrency exchanges in the world, Coinbase has had, frankly, a rough couple of months. They've had to contend with speculations about bankruptcy, deal with increasing regulatory scrutiny, and even handle internal employee dissent. So what's really going on over there? To help us better understand what's at stake for Coinbase, I'll be joined by Bloomberg Businessweek columnist Max Chafkin. This is Bloomberg Crypto, a daily podcast from Bloomberg and iHeartRadio. For more shows from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts. Send us your comments, questions, or suggestions for the show to crypto@bloomberg.net. Or find us on Twitter, we're @crypto. The supervising producer of Bloomberg Crypto is Vicky Vergalina. Our senior producer is Janet Babin. Desta Wonderad is our engineer. Original music by Leo Sidran. I'm Stacey Marie Ishmael. We'll be back tomorrow.